Welcome to our comprehensive USD/JPY analysis covering October 13th to 18th, 2025. This week saw the pair consolidate in a narrow range as markets awaited key catalysts. We'll examine critical technical levels, important news events, and provide actionable trading strategies for both short-term and medium-term traders. Our analysis draws from 5 leading sources: TradingView, Investing Live, Action Forex, Forex.com, and Daily Forex. Whether you're a day trader or position trader, this report will equip you with the insights needed to navigate the current market environment. Let's dive into the key developments that shaped USD/JPY this week. USD/JPY traded at 150.450 as of October 18th, showing a weekly decline of 0.85%. The pair remains trapped in a consolidation range between 149.20 and 152.40, reflecting market indecision ahead of major catalysts. Current price sits just above the critical 150.00 psychological level, which has proven to be strong support. The weekly range of 3.20 yen indicates relatively subdued volatility compared to the dramatic Takaichi rally earlier in October. Key resistance remains at 151.50 to 152.40, while support is anchored at 149.41 and 150.00. The market is clearly in a wait-and-see mode, with traders positioning cautiously ahead of US CPI data and Japan's parliamentary vote. 2 critical catalysts are on the horizon. First, US CPI data on October 18th marks the first major economic release since the government shutdown. Core CPI is expected at plus 0.3% month-over-month and plus 3.2% year-over-year. Services inflation remains the Fed's key focus and could trigger repricing of rate cut expectations. Second, Japan's Prime Minister vote on October 21st will determine if Takaichi can secure parliamentary support after winning the LDP leadership. Successful coalition talks with the Japan Innovation Party have already weakened the yen, as Takaichi's dovish stance reduces Bank of Japan tightening pressure. These 2 events will likely determine USD/JPY's direction in the coming weeks. Elevated market volatility is creating additional pressure on USD/JPY. The pair shows a strong negative correlation with volatility, with realized correlation at negative 0.85 and expected correlation at negative 0.87. This means when market stress increases, the yen typically strengthens as a safe haven currency. Trade tensions and banking sector concerns are driving risk-off sentiment, leading to carry trade unwinding. This creates downward pressure on USD/JPY as investors exit high-yielding positions. The volatility spike supports safe haven yen demand, making it crucial for traders to monitor broader market stress indicators. Any escalation in geopolitical tensions or financial instability could trigger sharp yen appreciation regardless of fundamental factors. Technical analysis reveals a mixed picture. The chart shows USD/JPY testing key resistance at 151.00 to 151.50, with the pivotal zone at 152.40 and October swing high at 153.28. Support levels are well defined at 150.00 psychological level, 149.41 Friday's low, which has proven reliable, and the 200-day moving average, which is critical for the long-term bullish structure. Price action shows a bullish pin bar on Friday, contrasting with a weekly doji, indicating market indecision at current levels. The pair is essentially coiling between these support and resistance zones, awaiting a catalyst to break out. Traders should watch for a decisive break above 152.40 or below 149.41 to signal the next directional move. Momentum indicators provide additional context. RSI has returned to neutral 50 level after reaching overbought readings above 70 during the Takaichi rally. This normalization suggests initial buying momentum has cooled, with neither bulls nor bears in control. MACD is approaching a bearish crossover but remains in positive territory. The signal line is converging with the MACD line, suggesting weakening upward momentum. A confirmed crossover would signal potential short-term downside pressure. However, moving averages show price remains above the 50-day MA, which is above the 200-day MA in a golden cross configuration. This long-term bullish structure remains intact despite the recent pullback, providing underlying support for the uptrend. Overall, momentum indicators reflect partial unwinding of the Takaichi breakout rally, with the market awaiting direction. For the next 1 to 2 weeks, we see a 55% probability of continued range-bound trading between 149.20 and 152.40. The market is likely to remain in consolidation mode until key catalysts provide direction. There's a 30% probability of bullish breakout if US CPI comes in hot, supporting a stronger dollar. This scenario targets 153.50 and potentially 154.80. Conversely, there's a 15% probability of bearish breakdown if risk-off sentiment intensifies or Takaichi faces political challenges. This would target 147.50 and 146.50. Key levels to watch: resistance at 151.50 to 152.40 and support at 151.50 to 152.40, 149.41 to 150.00. The upcoming US CPI data and Japan PM vote will be critical in determining which scenario plays out. Traders should be prepared for potential volatility around these events. Looking ahead 1 to 3 months, we maintain a 60% bullish bias with targets at 155.00, 157.50, and potentially 160.00. This scenario assumes the Fed maintains its cautious stance on rate cuts, while the Bank of Japan remains dovish under Takaichi's influence. The intact Golden Cross and strong U.S. economic data support this view. However, there's a 40% bearish scenario if risk-off sentiment dominates, or the BOJ signals unexpected hawkishness. This would target 147.50, 145.00, and potentially 142.00. The medium-term direction hinges on 3 factors: Fed policy trajectory, BOJ independence under Takaichi, and global risk appetite. The 200-day moving average around 147.80 serves as the critical line in the sand. As long as price remains above this level, the bullish structure stays intact. Several risk factors could impact USD JPY. On the upside, stronger than expected U.S. economic data, particularly CPI and employment figures, could push the dollar higher. Fed maintaining higher for longer rates would support USD JPY appreciation. Takaichi's dovish influence keeping BOJ policy accommodative is another bullish factor. On the downside, Tokyo authorities could intervene if USD JPY approaches 155.00, as they've done historically. Weaker U.S. data or Fed dovish pivot would undermine dollar strength. Unexpected BOJ hawkishness, though unlikely under Takaichi, remains a risk. Global risk-off events such as geopolitical tensions or financial instability would trigger safe haven yen demand. Traders must remain vigilant and adjust positions as these risk factors evolve. For short-term traders with a 1 to 2 week horizon, we recommend a range trading strategy. Buy setup: enter at 149.20 to 149.60 with bullish reversal signals. Stop at 148.70, targets at 150.50 and 151.20, offering 1 to 2 to 1 to 3 risk reward. Sell setup: enter at 151.50 to 152.00 with bearish reversal signals. Stop at 152.60, targets at 150.50 and 149.50, also offering 1 to 2 to 1 to 3 risk reward. For breakout traders, watch for bullish breakout above 152.60, targeting 153.50 and 154.80. Conversely, bearish breakout below 148.80 targets 147.50 and 146.50. Always wait for confirmation before entering breakout trades, as false breaks are common in consolidation ranges. Proper risk management is essential in this environment. Medium-term traders with a 1 to 3 month horizon should adopt a trend-following strategy. Buy setup. Enter at 150 to 151 on pullback or break above 153.50. Stop at 147.80 below the 200-day moving average. Targets at $155, $157.50, and $160. Take partial profits at each level to lock in gains. Key levels to monitor include support at 147.80, 149.00, and 150.00, and resistance at 152.40, 153.28, and 155.00. Track Fed policy, U.S. inflation, BOJ statements, volatility levels, and trade relations. Risk management guidelines. Never risk more than 1 to 2% of capital per trade. Use trailing stops to protect profits. Reduce position sizes ahead of high-impact events. Key principle: flexibility and discipline are paramount. Take cues from price action rather than maintaining rigid directional bias.